When it hits, they stand to get paid in three distinct and highly profitable ways. Through their recurring management fees, through surging Aladdin revenue as institutions panic, and through lucrative government contracts to manage the very bailout operation itself. For BlackRock, a crisis is not an unfortunate or unforeseen bug in the system. It is, quite clearly, an inherent and highly profitable feature. Now, let's direct our attention to the latest housing data, as it reveals a profound and increasingly intimate connection between BlackRock and your daily life. One that regrettably often goes unnoticed by the vast majority of people. There's a common but incorrect misconception that BlackRock itself is actively acquiring vast numbers of single-family homes across America. This isn't quite accurate. The company primarily responsible for buying up single-family residences at scale is Blackstone, a distinctly separate and unrelated firm. However, BlackRock is still deeply embedded in the pervasive financialization of housing, albeit through a different and equally potent mechanism. BlackRock functions as the largest institutional shareholder in the very companies that are actively purchasing these homes. They hold significant and influential stakes in Invitation Homes, for instance, which proudly stands as America's largest single-family rental company, boasting an extensive portfolio of over 80,000 homes. BlackRock also maintains substantial positions in American Homes for Rent, another major and rapidly expanding player in the institutional rental market. Furthermore, they are significant shareholders in the largest home builders in the nation, including industry giants such as Dr. Horton, Lennar, and Pulte Group. So, while BlackRock may not directly own your neighbor's house, they nonetheless profit immensely from the systemic and accelerating transformation of traditional homeownership into a pervasive, permanent renting model. In 2008, when financial titans like Bear Stearns and AIG teetered and ultimately collapsed, the Federal Reserve and the Treasury Department found themselves in an exceptionally precarious position, profoundly lacking a clear understanding of what these complex institutions actually owned, and crucially, lacking the specialized tools to accurately value their vast holdings of toxic assets. Their pragmatic solution? They unequivocally hired BlackRock. BlackRock was paid hundreds of millions of dollars to analyze, advise on, and ultimately manage the government's comprehensive crisis response. The very same scenario unfolded again in 2020 when the COVID-19 pandemic necessitated the Federal Reserve's unprecedented intervention to stabilize markets by purchasing corporate bonds on a massive scale. Once again, they explicitly turned to BlackRock to manage these colossal purchase programs. BlackRock was, in effect, paid handsomely to buy bonds on behalf of the Federal Reserve. This unique arrangement, however, exposes a profound and deeply unsettling conflict of interest. BlackRock is simultaneously the largest issuer of bond ETFs through its iShares division. So, BlackRock was in the unique position of advising the Fed on precisely which bonds to buy, and the Fed, in turn, ultimately ended up purchasing billions of dollars worth of BlackRock's own iShares bond ETFs. While this practice is not technically illegal under current regulations, it is a textbook definition of regulatory capture, a phenomenon where a regulatory body, ostensibly meant to oversee an industry in the public interest, effectively acts in the self-interest of the very regulated entities it is supposed to be controlling. This fundamental and deeply embedded dynamic explains precisely why BlackRock is not afraid of the next inevitable crisis. The crucial insight here is that these management fees are consistently collected regardless of whether the underlying assets appreciate or depreciate in value. If, for instance, the stock market were to crash by 50% and their managed assets consequently fell from $11.5 trillion to $6 trillion, BlackRock would still diligently collect its fees on that $6 trillion. While their total revenue might experience a proportional drop, they themselves do not suffer capital losses. They are managing your money, not actively risking their own. But the situation becomes even more profoundly advantageous for BlackRock because, when a major crisis strikes, they benefit from two additional and incredibly powerful revenue streams that experience an explosive surge. Firstly, their Aladdin business absolutely thrives. When global markets descend into chaos and financial institutions worldwide succumb to panic, they urgently require sophisticated tools to assess their rapidly changing risk exposure, conduct rigorous and immediate stress tests, and meticulously rebalance their portfolios with extreme speed and precision. They are more than willing to pay BlackRock handsomely for privileged access to the Aladdin platform to perform these critical, real-time functions. Historically, Aladdin's revenue spiked dramatically in 2008 during the peak of the global financial crisis, and again in 2020 during the unprecedented COVID-induced market turmoil. For the Aladdin division, a crisis is, undeniably, exceptionally good for business. Secondly, and perhaps most significantly, are government contracts. This is where BlackRock's immense and often subtle influence truly shines through. Perhaps the most revealing and potentially alarming data point emerges from their proprietary Aladdin system. In Q4 2024, the usage of Aladdin's sophisticated stress test feature surged by an alarming 47% compared to the previous year. This is far from routine. It unequivocally signifies that thousands of financial institutions globally are actively running complex simulations for severe market crashes, widespread liquidity squeezes, and potentially destabilizing geopolitical crises. This pronounced spike strongly suggests that BlackRock, along with its extensive and interconnected network of clients, perceives something specific, potentially disruptive, and highly significant on the horizon. When the very individuals and institutions managing trillions of dollars begin stress testing for worst-case scenarios, it's because they are diligently using BlackRock's sophisticated tools to gauge just how bad things could potentially become. The pressing and critical question, then, is, are you adequately prepared? Now, let me illuminate precisely how BlackRock consistently manages to generate substantial and recurring profits, even, or perhaps especially, during a financial crisis. Understanding this fundamental mechanism is absolutely key to grasping why they appear so remarkably unfazed by what may be coming. BlackRock's fundamental business model is deceptively simple. They systematically charge fees based on the total value of the assets they have under management, AUM. These fees are typically quite modest, often ranging from 0.3% to 0.5% annually, depending on the specific fund structure and asset class. However, when applied to a truly staggering $11.5 trillion in assets, even a seemingly modest 0.1% annual fee translates into an impressive $11.5 billion in annual revenue. In 2024 alone, BlackRock reported generating approximately $17.9 billion in revenue and a net income of $5.5 billion. But herein lies a crucial and often overlooked detail. While BlackRock's total assets experienced substantial growth, their internal allocation strategy underwent a significant and telling shift. In 2022 to 2023, their portfolios held a considerable 62% in equities. However, by late 2024, this figure had subtly but significantly dropped to 58%. This seemingly minor 4 percentage point shift, when applied to their vast asset base, translates into a massive repositioning. BlackRock strategically moved approximately $460 billion out of stocks. So, where did this staggering sum of capital find its new home? It was meticulously reallocated into significantly more defensive assets, primarily fixed income instruments, high-quality bonds, and robust cash equivalents. This is a quintessential defensive maneuver, a well-established strategy typically executed when sophisticated investors anticipate an imminent market downturn. It's fundamentally about consciously reducing overall risk exposure and actively bracing for heightened volatility in the near future. BlackRock might label this as mere portfolio rebalancing, but the accelerated pace of this shift occurred precisely as the S&P 500 benchmark index reached successive all-time highs, a clear and compelling indication that they are, in effect, strategically selling at the top. Further substantiating this pronounced defensive stance, late 2024 witnessed inflows into BlackRock's gold exchange-traded funds, ETFs, reached their highest level since 2020, with over $3 billion pouring into gold-backed instruments in a mere 2 months. Investing in gold is a time-honored traditional hedge, a strategy frequently employed when there's a fundamental erosion of trust in the broader financial system, a belief that fiat currencies will inevitably weaken, and a strong expectation that significant inflation is poised to make a return. In early 2025, BlackRock executed a series of strategic moves that unequivocally signal their remarkable foresight into the unfolding financial future. Their actions are not indicative of positioning themselves for sustained growth within a perpetually buoyant market. Rather, they conspicuously suggest a meticulous preparation for an impending crisis. When an entity of BlackRock's unparalleled magnitude begins to position itself for a downturn, it sends a powerful signal that demands our undivided and immediate attention. History offers stark and consistent warnings. In both the 2008 global financial crisis and the 2020 COVID-induced market turmoil, those who were unprepared for the inevitable market turmoil faced devastating and often irreparable financial losses. My precise aim here is to peel back the layers and lay bare exactly what BlackRock is doing in this current moment, to illuminate why their present positioning so strongly suggests that a significant financial crisis is on the horizon, and to reveal the calculated strategies by which they intend to generate substantial profits from it. Understanding BlackRock isn't about indulging in speculative conspiracy theories. It's about intelligently interpreting the highly strategic moves of the most powerful entity in global finance and grasping the profound and far-reaching implications of those deliberate actions. As of Q4 2024, BlackRock's total assets under management, AUM, reached an extraordinary $11.5 trillion, marking a truly substantial increase from $10 trillion in 2023. This means they successfully attracted and managed a colossal $1.5 trillion in new capital within a single year. From where did this immense influx of capital primarily originate? Overwhelmingly, it came from recurring 401k contributions, steadily growing pension funds, and the consistent stream of retail investors dutifully allocating money into index funds each month. Aladdin is far more than a mere software platform. It is a sophisticated, AI-powered risk management engine that meticulously oversees assets for thousands of financial institutions across the globe. This means that BlackRock, through both direct management and indirect technological oversight, wields significant influence over an estimated $32 trillion in financial assets, a truly staggering one-third of all financial wealth on planet Earth. BlackRock stands as the single largest institutional shareholder in corporate behemoths such as Apple, Microsoft, Amazon, Tesla, and an astonishing 18,000 other companies worldwide. When individuals invest in an index fund, which is a common strategy for retirement savings, they might reasonably assume they retain some degree of say in the companies they technically own. However, it is, in fact, BlackRock that actively casts the votes for those shares on your behalf. By acquiring a position in such a fund, you effectively relinquish your direct voting rights. This extraordinary collective power means that BlackRock, in concert with Vanguard and State Street, a trio frequently dubbed the Big Three asset managers, collectively votes 20 to 25% of all outstanding shares in most major American corporations. They possess the decisive authority to determine who gets elected to corporate boards, to set the often lucrative executive compensation packages, to approve transformative mergers and acquisitions, and ultimately, to shape the overarching corporate strategy of these entities. Crucially, they do all of this using capital that isn't even theirs. It's your capital. It represents your 401k, your pension funds, your carefully chosen index funds. While it's undeniably your money, it is unequivocally their vote. This arrangement arguably represents the greatest concentration of unelected economic power the world has ever witnessed. On March 10, 2023, a seismic tremor reverberated through the financial world. Silicon Valley Bank, then America's 16th largest bank, spectacularly imploded in a mere 48 hours. The repercussions were instantaneous and severe. A wave of panic gripped depositors. Markets plunged into disarray, and regional banks nationwide witnessed their stock prices plummet as investors grappled with profound fears of widespread contagion. Confronted by this rapidly escalating crisis, both the Federal Reserve and the White House were forced into emergency overdrive, and intriguingly, they all made precisely the same phone call. Intriguingly, that critical call wasn't directed to the nation's colossal commercial banks, nor even to the established financial regulators. Instead, it went straight to Larry Fink, the formidable and hugely influential CEO of BlackRock. This pivotal moment starkly illuminates a profound and often uncomfortable truth. When the American financial system teeters precariously on the brink of collapse, the government doesn't primarily turn to its own institutions. It instead calls upon the very company that, in essence, truly operates and underpins the system. BlackRock's sheer scale is nothing short of staggering. As of early 2025, it directly manages in colossal $11.5 trillion in assets. To truly grasp this magnitude, consider that this figure comfortably surpasses the gross domestic product, GDP, of every single nation on Earth, with the solitary exceptions of the United States and China. However, even this immense number somewhat distorts the full picture, as it only accounts for the assets under its direct stewardship. The authentic scope of BlackRock's pervasive influence becomes considerably clearer when we factor in the additional $21 trillion that flows seamlessly through its proprietary Aladdin system. The latest data unequivocally shows that this trend is not only continuing, but actively accelerating. In 2024, institutional investors collectively purchased approximately 18% of all single-family homes sold across the nation. In specific, high-growth,